Chapter 5 Cash Flow Determination 1 under topic Cash Flows. Chapter Learning Outcomes. At the end of this chapter, students should be able to first understand cash flow determination approaches, second, develop the managerial skills related to the cash flow determinations. Chapter Outline. There are 3 topics that we'll cover in this chapter. The first topic is depreciations under straight line method. Second topic is taxation, tax liability and tax shield techniques. The techniques are top-down approach, bottom-up approach and tax shield approach. And the third topic is under cash flow, where under cash flow, it will cover operating cash flow, OCF, cash flow after tax, CFAT, net initial cash flow and ICF, net annual cash flow and ACF, and terminal cash flow, TCF. As an introduction, the main purpose of this chapter is to construct after-tax cash flow, ATCF, or also known as Total Projected Cash Flow, TPCF, of the project. There are several important terms that you need to be understand before constructing the cash flow of the project. The terms are, first, depreciation, which is under straight line method, and salvage value, which is SV. The second term is under taxation approaches, where the approaches are top-down approach, bottom-up approach, and tax shield approach. The third terms that you should know is operating cash flow, which is OCF, and the last term cover is net initial cash flow and ICF, net annual cash flow and ACF, and terminal cash flow TCF. What is cash flow? As we know in this chapter, it's more focusing on how you can constructing for the cash flow. So at first, you need to understand what is a cash flow. Cash flow is the net amount of cash and cash equivalents being transferred into and out of a corporation's business activities. Cash flow also refer to the movements of money into and out of a business operations, typically categorized as cash flow from operations, investings, and financing. What is the meanings of the value of the cash flow? A positive cash flow indicates that the corporations will be able to settle its bill represented by expenses and also invest in growth. Meanwhile, a negative cash flow represents that a corporation needs to find an alternative source of income to be able to pay off the debts. And to answer for the purpose of this chapter, at the end, under cash flow, you will calculate after-tax cash flow, ATCF, or the other name is Total Projected Cash Flow, which is TPCF. Before you can start, construct, or calculate in terms of the after-tax cash flow, there are 4 terms related with the cash flow that you need to be understand and know. The first is operating cash flow or OCF. OCF represents the cash impact of a company's net income from its primary business activities. It's measure of the amount of cash generated by a company's normal business operation. So in a simple words, OCF represent cash of money that company will receive from their business activity. The second term is net initial cash flow or NICF. NICF represents the cash required to start a project or business. This cash estimated mainly at planning stages of a business or a project. So NICF represent a cost related to construct or to come up with a project or business activity of the company. Third terms is net annual cash flow or NACF. NACF represents the additional cash flow for a project or business. A positive cash flow indicates that there will be an increase in organization cash flow and chances for approving the project are high. And the last term is terminal cash flow, which is TCF. TCF represents a cash flow at the end of the project after all taxes are deducted. It also indicates that the net amount made by a company after disposing the assets and necessary amounts are paid. To start with a calculations on how to calculate after tax cash flow, you can refer to these examples of question. Based on these questions, Metro Holding Berhad intends to upgrade their production facility to meet its growing business expansion. The cost to upgrade the facility will be Rm 3 million, and based on this sentence, it mentioned that the cost to upgrade the facility will be 3 million. So 3 million here represent cost of the project or equivalent to IO, which is initial outlay. And to be depreciated on a straight line to zero basis based on this statement, which is depreciated on a straight line. So meaning that in this question, depreciation is given and you need to calculate in terms of the amounts of depreciation over a 5 years period of its useful life. And based on this statement, it mentioned that the useful life of the facility is 5 years. So useful life here represented by N. So N is equivalent to 5 years. Continue. The facility has an estimated pre-tax disposal price of Rm 500,000. Pre-tax disposal price here represent by salvage value. Disposable price equivalent to salvage value and pre-tax here represent before tax salvage value. So SV is equal by Rm 500,000. An initial working capital of 4% of the investment cost is required. An initial working capital of 4% of the investment cost is required. Based on this statement, it's mentioned that the amounts of initial working capital, so initial working capital here represent net working capital, which is NWC. So NWC equivalent to 4% time with the project cost, which is 3 million ringgit based on the amounts of IO. N, which is to be fully recovered at the ends of its useful life. So it's also mentioned that the initial net working capital will be recovered at the end of its useful life. So what is net working capital? Net working capital represent additional costs that also will be included to be paid by the company at the beginning of purchasing the facility. And because of its information regarding fully recovered, so meaning that the cost of net working capital that incurred at the beginning of the project will be recovered back at the end of the maturity period, which is will be recovered at year 5. So the required rate of return is 12%. So required rate of return represented by I. So I is 12%. And the tax rate is 25%. So tax rate here represented by T, which is 25%. Below are the additional information pertaining to this proposal. So based on the additional information, so there are information regarding annual fixed cost. So annual fixed cost here represented by FC, which is fixed cost. So the amount for fixed cost for year 1 until year 2 is RM 200,000, and for year 3 until year 5 is RM 220,000. And the second information and the additional information is regarding sales volume. So sales volume in quantity or in unit is represented by Q, which is quantity. So the quantity of sales for year 1 until year 2 is 52,000, while for year 3 until year 5 is 68,000. And next information, selling price per unit. So selling price per unit here represented by P. So P for year 1 until year 2 is RM 30 ringgit, and for year 3 until year 5 is 35 ringgit. And the last additional information is regarding variable cost per unit. So variable cost per unit represented by VC. So VC for year 1 until year 2 is 13 ringgit, and for year 3 until year 5 equivalent to 15 ringgit. And based of all information given, so the questions are first to determine all the relevant cash flow associated with these proposals, and the second questions is compute the project internal rate of return, which is IRR, and justify whether to reject or accept for the proposal. And to answer for all of the questions, for the first question is to determine all the relevant cash flow associated with this proposal. So to answer for that question means that we need to calculate several information before we can start constructing for after tax cash flow or total projected cash flow. So determine all the relevant cash here represent calculate in terms of after tax cash flow that available for the project. And to calculate for the after tax cash flow, there are 5 steps that you need to follow. By using these 5 steps, it is more easy for you to understand and to calculate in terms of the after tax cash flow. So based on the steps, the first step is to calculate depreciation. The second step is to calculate after-tax salvage value, which is ATSV. The third step is to calculate operating cash flow, which is OCF. The fourth step is to calculate change in net working capital if needed regarding the information in the equations. And then the last step is to calculate after-tax cash flow, which is ATCF, or the other name is total projected cash flow, which is TPCF. And to calculate or to answer for the first question based on the step, so we can start with step number 1 to calculate depreciation. So for step number 1, calculate depreciation, and based off the formulas for depreciation, so depreciation will be equals to IO divided by N. IO represented by initial outlay, and it was given in the equation the amounts of initial outlay or the cost of the project is equivalent to 3 million divided with N represented by maturity period. So the maturity period or useful life of the project is 5 years. So 3 million will be divided with 5 years. So you will get the amounts of depreciation is RM 600,000. And then based on step number 2, we can calculate after tax salvage value, which is ATSV. So to calculate for ATSV, the formula equals to salvage value time with 1 minus tax. And based on information, so the amounts of salvage value or before tax salvage value is RM 500,000. So we will time with 1 minus tax. Tax is given at 25%. So 1 minus 0.25. So you will get the answer for ATSV equals to RM 375,000. And the third step, we will calculate operating cash flow, which is OCF. Since the information of depreciation is given in the question, so we will use tax shield approach to calculate OCF. So as we know, to calculate for the OCF, we will apply taxation concept. Where under taxation concept, there are three types of taxation approaches. The first is bottom up, top down, and also tax shield. So, because of information regarding depreciation is given in the question, so you can use tax shield approach to calculate for the OCF. So, based on tax shield approach formulas of OCF, the formulas will be equals to Q, which is quantity, time with P, selling price per unit, minus with VC, which is variable cost, and then minus with FC, represented by fixed cost, will be time with 1 minus tax, and plus with depreciation, time with tax. And since the information regarding additional information are divided into two different years, so the first information is regarding year 1 until year 2, and then the information regarding year 3 until year 5. So since the useful life of the project are divided into two, which is 1 until year 2 and then year 3 until year 5. So that's why when we calculate OCF, so we will separate the amounts of OCF, which is OCF year 1 until year 2 and also OCF year 3 until year 5. So for the first OCF year 1 until year 2, based on the formulas, Q is equivalent to 52,000 time with P 30 ringgit minus with variable cost 13 ringgit and then minus with total fixed cost 200,000 and then time with 1 minus tax at 25% plus with depreciation 600,000 time with the tax 0.25. So you will get the amounts of OCF year 1 until year 2 is RM 663,000 ringgit. And for the OCF year 3 until year 5, so based on information, so Q is 68,000 time with P 35 minus with VC 15 and then minus with FC 220,000 time with 1 minus 0.25 plus with depreciation 600,000 time with tax 0.25. So you will get the answer for OCF year 3 until year 5 equivalent to RM 1.5 million. And after you complete step 1 until step 3, so next we continue with step 4, which is to calculate change in net working capital. And based on information, this step, which is to calculate change in net working capital, only will be calculated if the information regarding yearly net working capital is given. So this step only need to be calculated if net working capital for each year is given in the question. And since there is no information regarding yearly net working capital given in the question, so you are not going to calculate the change in net working capital, which is under step 4. So we will ignore step number 4. Okay, and then continue with step number 5. So we will calculate after tax cash flow, which is ATCF or total projected cash flow. So based on step number 5, means that we will answer for the question number 1. Okay, so to calculate for after tax cash flow, it is suggested for all of you to calculate by using the tables. Okay, so based on the table, the first column will start with the items, and the item should be included in this table. The first will start with OCF. Next is the change in net working capital, and then net working capital recovery. So R here represent by recovery, and then continue with IO, which is initial outlay, and then ATSV. So at the end, you will get the answer regarding ATCF or total projected cash flow, which is TPCF. Okay, so after all items are included here, so next we move to the next column. So we will start with year 0. So year 0 here represent by cost. So year 0 is represent cost. Okay, and then continue with year 1 until year 2, and then year 3 until year 4, and the last column is year 5. So since the informations are separate into year 1 until year 3, year 1 until year 2, sorry, and then year 3 until year 5. But when you are doing this table, you must separate the last year of maturity period, which is year 5. Okay. So to complete this table, so first item, which is OCF, so you just include OCF that you already calculate in step number 3. So OCF for year 1 until year 2 in step number 3 is amount 663,000. And then OCF for year 3 until year 5 that you calculate in step number 3 is amount 1.5 million. So just include the information here under OCF. Okay, and then for second item, which is change in net working capital. Okay, so for change in net working capital, at first we will start the amount at year 0, represent the cost. So at year 0, you will include the initial net working capital given in the question. So in the question, it was mentioned the initial net working capital equivalent to 120,000. So at the amounts of initial net working capital given, 120,000. And then since this column is represent cost, you need to put bracket here at the amounts of 120,000 because it's represent the cost. So bracket here represent the cost of net working capital. Okay, and then because there are no information regarding yearly net working capital, so no need to calculate or to add the amounts of net working capital for year 1 until year 5 because there is no information regarding the amounts of yearly net working capital. Okay, so next we move to the third item, which is net working capital recovery. And based on the information given in the question also, it was mentioned that the net working capital amount, which is 120,000, will be fully recovered at the end of maturity period, which is at the end of year 5. So meaning that the amounts of cost 120,000 of net working capital will be recovered back at year 5. So at net working capital recovery here, you add the amounts of 120,000, which is the initial amounts of net working capital, because it will recover back at year 5. Okay, and then continue with item number 4, which is regarding IO. So under IO, you need to include the initial cost of the project or the cost of the project. Okay, so based on information also in the question, it was mentioned that the cost of the project is 3 million. So you just add 3 million here, and because year 0 is represent cost, so you must include bracket here, represent cost. So the amount is 3 million, and for IO, the information is only happen or it's only incurred at year 0 only. So you can ignore IO for year 1 until year 5. There is no amount here since IO is only happen or it's only incurred at year 0, represent the cost at the beginnings of the project. Okay, and the last item, which is under ATSV. So for ATSV, because it represents salvage value, and as we know, salvage value is represent the value at the end of maturity period. So that's why the amount of ATSV will be at year 5 only. Okay, so after you include all of the information starting OCF until ATSV, so now you can calculate for ATCF or TPCF. So to calculate for ATCF, you should plus all of the item for each of the column. So for year 0 regarding cost, so just add 120,000 with the 3 million, so you will get the amount 3.12 million. And because that is under cost, so it must be bracket for that value. Okay. And then for year 1 until year 2, so you just add information on OCF only because they only have information on OCF. So the amount is 663,000. And then for year 3 until year 4, so the amount is 1.5 million only because that is the only item under OCF. Okay, and then for the last year, which is year 5, so you should total up the amounts of OCF plus with net working capital recovery plus with ATSV. So you will get the amount 1.5 million. Okay, so based on that calculation, so here is your end answer for the after tax cash flow. So from this information, so you will get the amounts of cost of the project, which is 3.12 million. So the amount at year 0 also represent by NICF, which is cost at the beginning of the project. Okay, and then the amounts of after tax cash flow starting from year 1 until year 4 here is represented by NACF, which is net annual cash flow. And the last one, the amounts of ATCF at year 5 is also represented by TCF, which is terminal cash flow, or it also equivalent to the cost at the end of the project. Okay, and then continue with the second questions of the question. Okay, so based on the second question, compute the project internal rate of return, which is IRR, and justify whether to reject or accept the proposal. So from the calculations under step number 5 in question number 1, so we can conclude the after tax cash flow like mentioned in this table. So at year 0 represent by cost of the project or NICF, net initial cash flow, amount to 3.12 million. And then for cash flow under year 1 until year 4 is represented by NACF, which is net annual cash flow. So the amount is given here for year 1 until year 2 is 663,000. And then for year 3 until year 4 is 1.5 million. And then the last one, which is cash flow at year 5, is represented by TCF, which is terminal cash flow, amount 1.5 million. And then to answer for this question, to calculate IRR, so we will use these informations in this after tax cash flow that already calculate in question number 1. And then by using the financial calculator, we will calculate IRR, which is internal rate of return. And to calculate IRR using financial calculator, so here is the command that you should know to calculate by using financial calculator. So the first one, you should press the button of CF from the financial calculator, and then you should add the amounts of initial outlay, which is 3.12 million, and then plus minus enter, and then you will add the amounts of cash flow year 1 until year 5 based on CO1, CO2, CO3, CO4 and also CO5. And then you will press the buttons of IRR compute. You will get directly the amounts of IRR 14.28%. So this is the answer for IRR. And then based on the answer of IRR, the question asks to come up with a decision either to reject or accept for the proposal. So to reject or accept for the proposal, based on decision, you should accept this project because IRR is higher than required rate of return given at the question, which is at 12%. So to come up with this decision, you should compare the amounts of IRR that you get from financial calculator with the rate of return or I given in the question. So if your IRR answer is higher than rate of return given in the question, means that you should accept. But if your IRR answer is lower than rate of return given in the question, means that you should not accept. Now, so since based on this question, you get the answer of IRR is 14.28%, while the return given in the question it is at 12%, so means that your IRR is higher than rate of return given. So that's why you should accept for this project. The reasons is because IRR higher than required rate of return. So that's the end of this topic. Thank you.